and welcome to Macros with Mythili, where we take a hard look at all the major macroeconomic developments in India and overseas. One development that held centre stage in the past few days, and if events in the Rajya Sabha are any indication, is likely to remain the focus of attention for a while. It is the insurance bill. Following the submission of the report of the Parliamentary Standing Committee on Finance and the government's decision to go with all the amendments suggested, it's only a matter of time before the bill that seeks, among other things, to raise the ceiling on foreign investment insurance becomes a reality. But just how much of a difference will it make to consumers, to the insurance sector and to the economy at large? Will there be a rush of foreign investors to the sector? To answer all these questions and many more, we have some of the best brains in the insurance sector. John Holden, CEO, Canara, HSBC, Oriental Bank of Commerce Life Insurance Company, R Krishnamurthy, former MD and CEO, SBI Life, and Ashvin Parekh, founder, Ashvin Parekh Advisory Services. Welcome to the show, gentlemen. Ashwin, if I might start with you, the insurance bill is usually equated with an increase in foreign direct investment or an increase in foreign investment at all. But if you go through the notes of dissent to the Parliamentary Standing Committee, they all say that foreign investment hike is neither a necessary nor a sufficient condition to get greater penetration in the sector. Would you agree with that view?
It is. There are three things about insurance sector. If you're to look at the significance of getting foreign investment and foreign capital into India in the insurance sector, then you have to view it in different sectors. Life insurance company, the top 5 or 7 companies have almost reached a point where they do not need any further capital. However, if the foreign investments came in, not necessarily through FDI, but through composite foreign investment, then life sector can improve their penetration through the additional capital. General insurance will require more capital arising out of more penetration that will happen if they go retail, if they really expand their base, so general insurance does require. Health insurance requires substantial amount of capacity and capital. So there I'm seeing a huge benefit. And then we shouldn't forget the reinsurance sector. There is no reinsurance capacity in this country. There is no reinsurer in this country. If we bring in more capital, then that capital will be available to the conglomerates and they can think about putting up reinsurance companies in India as well. So I'm saying, that if the penetration has to increase, if the companies have to write more business or the reinsurance companies have to come to this country with huge capacity, then foreign investments and foreign capital does become very critical. It's either through FDI or through other means, Mythili.
Okay, so let me turn to John at this moment. John, there were some notes of dissent to the Standing Committee report, and all the dissenting notes said, well, it's neither necessary nor sufficient. What is your view? Do you accept that it might be necessary but not sufficient, or you think it's both necessary and sufficient?
I think it is necessary, and as Ashwin said, I think the reports would show between maybe 20 and 50,000 crores required over the next 5 years. So that's a lot of money to be found at a time when there are other sectors also demanding capital for growth and infrastructure. So there's a need for sure, and also there's an appetite such that the insurance companies want to have the capacity to write more insurance and underwrite those promises that they give to customers. So I think that there is a desire on everybody's part to grow the industry, to reach more people with insurance, and we need that capital to underwrite the promises that we make to the customers.
Mr. Krishnamurthy, there seems to be an assumption that the moment you open it up to foreign insurers, everybody will come rushing in. So is that a right kind of view, or is it that foreign investors will take their time to come in? There's no great urgency as far as they're concerned, nor is there so much promise in the Indian market. Would you concur with that view?
Mythili, my view is we have been romancing about this FDI hike for quite a long time. And when it reaching a stage of fruition, there are still a number of policy questions and some confusion in the minds of policymakers. I understand that this FDI hike, the composite 49%, is likely to come with some riders attached like Indian owned and Indian controlled. I frankly don't see what's the meaning of Indian controlled and Indian owned. There are no such restrictions in any financial services, in banking, NBFCs, asset management, anything of that nature. Why we have this hang up that when we let up foreign holding to come to 49%, you put strings attached to it. And again, this change is coming at a time or the proposal is being brought at a time when the industry is passing through not a very good phase now. In fact, out of the first 6-7 years of heady growth and compounded growth of more than 30%, in the last 3-4 years, we are in a state of, I would say, very moderate and even negative growth. In fact, in the first 6 months of this year, there is a negative growth of nearly 2%. The total premium is close to 49,000 crores, and which is 2% less than the comparable period last year. And in fact, in the number of new policies issued, there is a sharp deceleration of more than 52% in this year, which is about 9.56 million policies as against 20 million policies comparable period last year. So I am a bit worried that at a time when we are talking with a great sense of gusto that we are raising FDI and going to invite huge people to come, the market is in a state of a sobering attitude. And in fact, the regulation which have been substantially on the development oriented phase has moved into a regulatory phase in the last few years. So we need to be very clear what are our expectations, what exactly we expect to achieve, especially when we need close to 50,000 crores capital by 2025 by life insurance companies alone. Are we ready to accept the new players coming in life companies, in general, in health insurance companies with an open arm and provide a really level playing field?
Absolutely. The requirements of capital are huge, John, but you know, the discussion all along was about raising the ceiling on FDI. But what we see in the bill is a composite cap with FDI and FII allowed. Now, for a business like insurance, particularly in the area of life, which is a very long-term kind of business, is it wise to treat FII and FDI on par, or should FDI get slightly preferential treatment because FII flows are always fickle?
I think that FDI would be my preferred route because it allows what we would call domain capital to come in, long-term patient capital. FII, I'm curious of what, I think that the devil, or actually the God, will be in the detail when we will begin to understand what the regulators actually require as a formula for both these things. I think perhaps the legislation is designed to enable a mixture of FDI and FII, perhaps when companies go to market and float. But in the interim period, I'm not sure how that will play out. But I think it's for the shareholders at the moment, pre-flotation, to agree how they want to fund the increase in capital, and then for whether it's a mixture of FDI or maybe exclusively FDI with the option of FII in the future. And then, but all the time keeping that 49% cap, which seems to be very important to the politicians and the lawmakers as they are deciding how much foreign investment they want to allow into the Indian industry.
Absolutely. We'll have to leave it to the policymakers and wait for the rules to understand exactly how much is to come by FDI and how much by FII. But on that note, I'm afraid we have to slip into a very short break. But please do stay with us. We'll be back very soon. Welcome back. You're watching Macros with Mythili, and we're discussing the implications of the insurance bill, which, if we are lucky, will soon become an act. Ashwin, before the break, John was just talking about the rationale for FDI and FII being a composite cap. How wise is that? Or would you like the government to specify some sub-limit for FDI within that, at least in the rules, if not in the act?
Yeah, I mean, see, I have been associated, with about 35 plus partnerships out of the 53, 54 that have happened. And believe you me, I mean, each one is a distinctly different shareholder agreement. The two sets of shareholders, the foreign shareholders and the Indian shareholders, when they started the journey, some started the journey almost 12 years ago, many more came in much later. But when you started that journey and you had envisaged a certain kind of an opportunity coming out of the increased FDI limit, things were so different. Now, what seems to have happened is, on account of the global financial crisis, some of the insurers, foreign insurers, are now focusing more on their home countries. They are focusing more on bringing the capital back to their home jurisdictions. In such a scenario, I thought you know, it would be very wise and prudent, and that's what I believe the standing committee is recommending, a composite kind of a number of 49%. What it would really mean is the rest is then left off. To my mind, it should be left to the shareholders to decide. If a foreign investor is interested in taking his equity right up to 49%, he could do so through the FDI route. If, on the other hand, both the promoters believe that they want to give some amount of their equity to the market, then they give it to the market. In insurance companies, particularly in life insurance companies, my experience, I mean, after practicing in 3-4 other markets, is that you widespread your equity, you allow institutional and retail investors, domestic as well as foreign. It gives a little bit of strength to the insurance company. So some may decide to do that, and then the others, you know, may try and do a shareholder to shareholder transaction. I mean, in some of the companies, for example, there's no need, for example, to take the capital to the market. Then the Indian shareholder may sell his part either to FIIs through the market, or he may sell it to through the FDI route. I would say I would welcome an open kind of an environment with no clauses, not even on voting rights, so that the equity which has been offered to the foreign investors is at par with the other equity.
My view is there's not going to be a rush of the Indian promoters to sell immediately, and I agree with Ashvin that whether it is 20 FDI or FII within 49%, what's the composition must be left to the good sense of the board. Instead of government putting a micro control of how much is FDI and how much is FII. Please let us understand that all the life companies as well as a few general insurance companies are going to be ripe candidates for public listing very soon. When the listing takes place, there is going to be FII participation along with the domestic participation. There is going to be a lot more messy if you are going to put the sublimit and then monitor the sublimit to the aggregate extent, and these are all historical baggage. I think time has now come when we basically say that we let foreigners own 49% in insurance companies, full stop. How it is monitored, how it is sublimits are fixed, these are all individually left to the companies, managements negotiate, and as evolving market mechanism works out, there could be any number of alternatives and options.
Okay, there are many options that are possible, but John, HSBC is a foreign investor in a relationship with 2 public sector entities. If the bill becomes a reality, would HSBC be interested in hiking its stake? And what about other foreign investors in India?
I'm the guy who runs the business, so I can't speak for the shareholder. So what HSBC will do will be a decision made by the shareholders. I think taking this more broadly, and also looking at the excitement around the FDI discussion, I think everybody who came to India came for the whole story, not just for 26%. So I think the foreign investors or the foreign shareholders as a category, I think are all looking forward to the opportunity to having a greater stake in the Indian insurance industry. Because if you buy the India story, that this is an emerging market with an emerging middle class and a great opportunity, if you buy that story, then why would you not want to be part of it? I think over the last couple of years we've seen some people leave, we've seen some new people come in, and that is all fine and part of life. But I see there's a lot of excitement and been a lot of excitement and anticipation for the bill and the FDI limit. So I think the bill opens up many more opportunities and paths than have been available to this point.
Absolutely. So the bill opens up many more opportunities that were available in the past. But I'm afraid on that note, we have to slip into another short break. But please do stay with us. We'll be back very soon. Welcome back. You're watching Macros with Mythili, and we're discussing the implications of the insurance bill. Ashwin, before the break, John was saying that, well, overseas investors are buying into the India story and they want to, they're not going to settle for half measures, so they should be allowed to come in with open arms. But if you look at the performance of the private sector in the insurance industry, whether it is life or general, the public sector entities have largely held their ground. In fact, public sector entities have done fairly well, especially in the case of life insurance. So does that mean that the private sector has not played its full role, or the private sector has not proved to be as much of a threat to the public sector? Is there something missing over there?
No, I mean, I would look at it in a very different manner, Mythili. Right from the time when the sector opened up, there was this question about how much will the public sector entity, I mean in this particular case in life there is only one, that is LIC, how much will it share to the private insurers? The question to my mind is very academical. I mean let me clarify. You see, India is a vast market. From every possible macroeconomic indicator, the penetration has to be much more than what it is at this point in time. So in addition to market share, I suppose penetration is also equally important. With the sector opening up, despite the fact that LIC has been able to keep its grounds and the grounds are on all fronts. I mean, they have really done well in distribution, they have done well in product design, they continue to do well in servicing as well. So they're holding out those grounds, let's say, gradually they may shed some market share, few, percentage points but by and large they've retained their market. But the market is growing. Let's not forget that the market is growing, and with adequate fiscal measures, you know, the market can really expand much more. There is a need for the planners and the policymakers to sit back and really see whether life insurance can be made an effective instrument for savings, particularly if we need long-term saving, long-term assets, infrastructure assets in the country. Then I suppose fiscal measures will go along, should go along with that. I'm not suggesting that a lot of concessions only in regard tax should be given, but I suppose there are so many impediments that come in the way, you know, that can be removed. The investment assets, I mean, in which the life companies can invest, can be expanded a little further. These measures will go a long way in expanding the market. The capital will be utilized, and the public sector life insurance entity need not shed its market share. It can continue to grow in the market, basically.
Mr. Krishnamurthy, Ashvin spoke about how, you know, insurance penetration, we need to increase the penetration. But if you look at the India numbers, penetration of insurance in India is about 3.9%. And that compares quite well with the worldwide average of 3.5, the US number of 3.2. So is our drive to open up the insurance sector driven more by the need to get foreign investment into the country? Or is it driven by the need to increase penetration? If we are doing quite well on the penetration front, then what is the need to open up further, particularly if it, you know, exposes us to fickle FII flows?
I think in terms of penetration, we need to go a long way, Mythili. We have been rather focused on the top line growth in almost all companies, and that is true even of bank promoted joint ventures. In fact, if you look at the debate when Malhotra committee report was discussed in the parliament, there is expectation that when joint ventures come with public sector institutions like banks, we would go a long way in promoting the insurance as a protection tool to millions of people. But what happens today, the value creation in all the companies in private sector has happened only through looking at the top line growth so far. And that is one of our biggest gaps in opening up so far. Take for example the bank promoted joint ventures. Why the banks have not gone into the big way to small ticket items to bring in people, millions of people, SMEs, small scale industries and small entrepreneurs, banking with them under the life insurance cover. Banks, for example, provide thousands of crores of assistance to, for example, road construction and other infrastructural projects. Have you ever thought of a singular plan of covering all the workers wherever they are, and as they move from one work site to another work site, completely under insurance cover, all because the banks hold the key in terms of financing? No. I think in terms of approaching the real insurance penetration to benefit the public at large, I think we have a long way to go. And I agree with the regulators' concerns on that. The insurance companies need to be far more looking at the opportunities available to reach a wider population base instead of looking at an elite force top line growth in some select towns. And even in bank distribution, the average penetration ratio is much less in smaller towns and villages.
Okay, absolutely. But I'm going to direct that question to John. Mr. Krishnamurthy said that why haven't these bank promoted joint ventures gone after small ticket numbers? So is that a case that, you know, there is this general belief that the private sector insurance companies have done cherry picking. They're into the top end of the scale, but they're not interested in the small man. So will that change with opening up insurance, John?
I'm going to disagree with Mr. Krishnamurthy, who I dearly respect and love. Because in our business, where we have 6,000 branches of Canara Bank, Oriental Bank of Commerce and an HSBC, we will sell policies each year in 90% of those branches. I can't tell you we get to 100 because that's not true, but I can tell you it's into the 90s. And that's been true in every year since we began in 2008. So I think with a bank assurance model, where the infrastructure of distribution comes for free because you're using the bank branch network, there's clearly an opportunity to reach way into the furthest corners of the country. I do recognise that some insurance companies where they have agency infrastructure prioritise the agency around the bigger tier 1, tier 2 cities. But I think there's an element of you have to go fishing where the fish are. And we have to balance the development of the country, the opportunity, and then where we can economically service the product. And I think the bank assurers have a great opportunity to leverage the network that comes for free with the bank and reach out to the whole population. I do see and agree that there is a need to get to the protection to the population rather than only focusing on the quasi-savings type products. But I think it's important to provide a social security net to the common man.
Ashvin, we are coming almost to the end of our program, but before I wrap up, I'd like to have a quick answer from you. Why is it that in the case of the private companies, we find that their claims ratio in terms of lapsation of policies, their performance lags far behind that of public sector companies? Is it that the case that for once public sector is more efficient than private sector?
Well, no. I suppose what seems to be happening is, I mean, this is a question that the private sector industry has been facing right from the very beginning. You know, the volumes, I mean, when you look at the overheads, for example, the public sector, the company in question has already had a head start to begin with so many policies already sold. So the trail premium keeps on coming in on one side. And B, more significantly, I would say, you know, just not that. I mean, the overheads are spread over a much larger volume. So, I mean, that's one part. So, if you look at the indicators in terms of percentages, that's one. On penetration, a quick one, Mythili, you know, we look at both parts. 80% of the premium is savings, not protection in the Indian context, and we don't have social security, Mythili.
Absolutely. Mr. Krishnamurthy, can I ask you, why is it that no private insurance company has come out with an IPO? After all, listing was allowed and, you know, they were supposed to list after 10 years and some of the private companies have been making profits. So what's holding them back from listing?
Well, frankly, if I'm a local promoter, I would look for the most appropriate opportunity to unlock value from the investment. And frankly, the market is in a stage right now where I believe that by holding on for some more time or waiting for more appropriate opportunity, we'll be able to unlock better value. It's ultimately the promoter's decision. Frankly, the industry need to get that fish once again back. Once it gets, believe me, promoters will be too happy to go to the market to unlock values, and that is the biggest challenge today, both for the regulator as well as for the players, how to get the industry back to a good trajectory of growth going forward. The development role, I think the IRDA need to be drawn much more actively, and from the insurance company side, they need to put on a great sense of confidence. Yes, this market is very big, and what they have done so far is very fraction of what is feasible in this market. So with a great sense of self-confidence in the future, and the confidence in the future and our self-confidence on our own abilities, the companies can do much better.
And now before I turn to John for the last word, very quickly, Mr. Krishnamurthy, I want to ask you, is the regulator, the IRDA, in a position to handle the influx of new players that we are likely to see if we're lucky?
Sure. I think the regulator is far better positioned today, very capable, seasoned, and we are getting the best of the world's practices. But at the same time, let's not underplay some of the practical constraints of regulator. And I am for one who have been seeing the regulator's office right from the day it was opened up 15 years ago. Still, the physical constraints, infrastructural constraints. In fact, the very fact that they sit in Hyderabad to some extent is one which affects interaction with the active players. I am of a votary to say that at least in 2 weeks a month, the regulator should play out of Bombay, so that there is more interaction, more understanding and everything. But in terms of overall understanding the market and able to regulate the players the most optimal direction, we can give really high marks for our regulator, the way it is shaped up, and it is really being alive to the challenges of the market.
Okay, so we will urge the regulator to move to Bombay, whatever it means for that city's infrastructure. But John, a final word from you?
We talked a lot about FDI. I think there is another story in the Act, which is what it does is it enables the regulator to regulate. A lot of the power that has previously been vested in the Act is now vested in the regulator. And I think this is very welcome and exciting opportunity, because it allows the regulator to move with the times, to create regulations that enable the market to move forward. And I think this is a positive that perhaps gets lost in the dialogue, which is going to enable the industry to hopefully to be more responsive and to grow into the future.
Absolutely. So it's a great opportunity for players, for the economy, as well as for the regulator. But I'm afraid that's all the time we have in this edition of Macros with Mythili. Thank you so much, John, Mr. Krishnamurthy and Ashvin, for joining me in this discussion. Thank you also for watching. But we'll be back next week with yet another edition of Macros with Mythili. Till then, it's thank you and goodbye from all of us at ET Now.
Find us on Facebook at facebook.com/ETNow, and don't forget to click the like button. You can also follow us on Twitter at ETNowLive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/user/ETNow.